All right, so the week didn't quite finish on a high note. Markets came coming into expiration on a little bit of a decline. The question is whether it's the spark that will lead to more, or whether it's another buy the dip opportunity coming out of expiration, kind of similar to what we saw at the last options expiration. So we're going to break down the possibilities of either of those happening and what's going on with small caps, because that's really the big story is the chart for the small cap index that we've been looking at all week. You know, how is it still in its pullback? Is it kind of a fake pullback? Is there a chance that this could be it for its weakness, like the other two times it's fallen to similar levels? So we're going to break those charts down as well. And then finally, our trade idea of the day is a stock that's got a really good bullish looking chart across multiple indicators, but it's got a little bit of a bearish pattern in the short term right now. So how can I trade this bullish trend with a lot of good bullish breakout indicators, but with the possibility of very short-term weakness? So we'll talk about how to do that. Let's go ahead and get started. Today is Friday, July the 16th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator like we always do. You can see the short-term sentiment really dropping, but not, I mean, as low a levels as they can get without being bearish, right? So if the momentum line drops below the red line, drops below that dotted line, then that's pretty bearish for the momentum line. That signals the possibility of you know, a trend reversal. For the last time we had that, we bounced without it happening, but you can kind of see that things get more bearish when you get the momentum line dropping to below that 5th percentile. And we came close twice this week, but neither time finished down there. The blue line, its bearish territory is this oversold reversal zone. You notice this whole time we've been bullish, we've rarely dipped down in there. And we especially haven't gotten like below the 10th percentile. Like, we just are not, I mean, we didn't even get down there when we actually had an intermediate decline. So it's rare for the blue line to get down there when you're in bullish trends. And so you notice we didn't do that here either. So despite how bearish the S&P ended up today, it still wasn't, you know, the short-term sentiment still doesn't show that, it is, you know, that the trend change is imminent. The S&P, the intermediate line is still well above 80. The market sentiment line's falling, and it's really, really close to 80. But, you know, so take that for what it's worth. But it's still very high, and it's easily above 60. So you know, this is, you know, just a near-term decline, which is all it is. The near-term line's dropped below 40. Last time it did that, we had this kind of move, and we bounced off of that. And we had an expiration cycle long near-term rally that's just barely ending right now. And we pretty much had an expiration long near-term rally there with one little dip in between on the last expiration cycle. So, you know, there's a decent chance that we could do that again. The short-term sentiment's not showing anything different. In fact, it's even less bearish on the Dow, and the NASDAQ's a little bit more bearish because keep in mind the NASDAQ is a higher beta, so it's going to typically look a little bit worse for the wearer than the S&P will. The Russell 2000, on the other hand, that's a different story. I mean, that the intermediate posture is strong. It's a lot stronger, more bearish than it has been. It's about as bearish as it was when we were culminating its intermediate pullback. Its only intermediate pullback here. You notice that both the near-term line and the momentum line are stuck in these short-term reversal zones. So really oversold levels in a short-term basis. And then you can see market sentiment lines falling. It got up to 60, which is bullish territory, after breaking down out of it, but then was unable to get through it, and is already reversing. So much different story, and getting a lot closer to flirting with that 23% retracement level. And I mentioned in my class today, in my technical analysis class on Market Scholars, I mentioned that once we break this 23% line, I think that's when the full risk aversion trade comes on. So we've had bits and pieces of a risk aversion trade with the Russell falling here, the Dow falling there, the NASDAQ falling here, but never broad enough to where even the S&P has fallen. But this is a situation where We probably could get to that that scenario if and when, because I mean ultimately it will happen. It's not like we can go forever without breathing out, right? So if and when it does happen, it will happen when the Russell breaks this line here, right about 2140 or so. And it can't just do it like like just a smidgen, right? It's got to be a good breakdown below that. And so, but again, this smidgen that we had over here, the near term over here, I mentioned before, the short term sentiment was bearish, but it was before the intermediate line dropped below 40. Intermediate line dropped below 40 after we bounced back up. Over here, we dropped down. The intermediate line hadn't dropped below 40 there either, and neither did the short-term sentiment drop to bearish levels at all. And then finally, now we are getting the short-term sentiment on the drop below 40, and we're getting, so that's why I think there's a good chance that we do it this time on the Russell 2000. And like I said, until we break this level, I don't think we're starting a pullback here until then, right? And because you can see we're still very far away from an intermediate, from dark pink shading and a red line. See, we have dark pink shading and a red line here. We are way far away from that happening on the S&P. So it's still got some things to work out. But you had that near-term divergence there that we're working towards that low point on that near-term divergence from the lower highs in the blue line, the higher highs in the index. Granted, we had a little bit of a near-term pullback now, but that's about it, right? There's nothing more significant than that as of right now. Let's take a look at the weekly chart since we are done with the week on the market forecast. And you can see that we have a bullish intermediate confirmation signal. So we did get the momentum line dropping here below the 20th percentile while we still maintain a very strong bullish posture. The near-term line still in the upper reversal zone, so technically that little oversold momentum line gives us an opportunity that we might rally. I mean, you look at every other time that we've dropped in the reversal zone. Here it took 2 weeks, but we bounced right out of it. Even when we get to an extreme low, we bounce right out. Over here, we bounce right out. Over here, we bounce right out. Over here, it took a couple, 2 or 3 weeks, but we bounced right out. And here's a couple that look like the one that we're on right now, where we didn't have a strong bullish posture at that point, but you notice we bounced up both weeks from that oversold momentum line. You can see some more examples of an oversold momentum line, and then we bounced right out of it, and that was going into the end of the year there. So that suggests that we could have a bullish week next week on the S&P 500. The Russell 2000, let's take a look at that weekly chart, because we all know that's going to be different, right? You can see the momentum line did drop to an extreme low there. The intermediate line is just turning bearish. Right now, the Russell is forming what could be a light pink shading and a yellow line pattern on the weekly chart. Now, you notice on the S&P, we're nowhere close to that. But on the Russell, we are, because we've been so sideways that the moving average has now caught up to where price is on the weekly chart. And this isn't, we bounced down below 40 in the near-term line. We got to an extreme low here. And you're, for all intents and purposes, you have a light pink shading on that. I might not go too much further down, but even this pattern on the weekly chart suggests that we could bounce off of this coming out of expiration next week. So while I do think that we are heading, and you'll see in a minute here, heading into a seasonally bullish time for volatility, I don't necessarily think that next week's that week, right? It's, we don't necessarily have that catalyst yet that says, sell-off, right? We have earnings season coming up, and that could add some fuel for, any last legs higher on the near-term line there. All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us 2 things. Number 1, that you liked our video today. And number 2, you want us to do another video again on Monday. It's a quick way to give us feedback if you like our videos. Of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch. But if you do and you want to let us know, you can do it right now with 1 click, even while you're watching here. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things here on the right, including our Market Outlook live trade reviews. This is where I go through all the Market Outlook trades I've done. We close out a couple of them. We rolled one. We closed out a couple here lately in the Market Outlook of trades I've done in previous videos. And I talked about them here in this video. And then I've already put on today's trade before the weekend. I also put it on today before the market closed in this live trade review. So it's just a quick 10-15 minute video that we do. It's live. You can do it while you can attend while I'm doing it. Be able to interact with other people as well as myself, as well as our trading rooms over here on the right. Our Q&A sessions are unique. They're for our premium subscribers, but the rest of our trading rooms, you can see here again, all of our subscribers get access to our 8 trading rooms and our 3 Market Outlook live videos that we do every week. So you get access to that. As our premium subscribers, of course, get access to all of that for cheaper per month. It's a 3-year subscription, however. You also, in addition to that, you also get access to our class forums, again, only available for our premium subscribers, and our premium tools as well and resources. Come down here, click on this thumbs up or heart, opens up a new tab, hit that like button right there. Click on this heart, opens up another new tab. Hit that like button there as well. Again, the more likes we get, the more our content gets viewed by our followers. That's how their algorithms work. So that's why we always ask, and we appreciate those who do like them. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with. So we try to make it easy for you to engage with us right here while you're watching the video. All right, back to the charts, and you can see another reason why it doesn't look like we're going to get, a pullback here anytime soon, like we are getting right now already in the Russell, is because you notice the difference, right? We had multiple transition candles. We're closer to the 50-day moving average. That's not the case here. We're still getting bullish candles. Now, next week's candle looks like has the potential for being a transition, as the open will be at 43.32-ish, maybe a little bit higher. The midpoint of that body is where it's going to be. And we're already trading at 43.27. So, there's a little bit bearishness to begin with next week with. But for the Russell 2000, of course, we are well on bearish mode. Like, these are bearish candles. We got a red arrow. The 50-day moving average is falling. The PPO, as I mentioned to you before, is still higher than it is on the S&P. So despite all that weakness, and despite multiple attempts at the beginnings of an intermediate decline, this being the third one, the PPO is still higher for the Russell than it is for the S&P 500 and for the NASDAQ, for that matter, at 8.63. So again, that goes to show just how insanely bullish the Russell was, and why it's probably better to be more bearish on the Russell than it is the NASDAQ or the S&P, because it's got a lot still. I mean, it's been unwinding. It's unwound about half, and it's still very extremely bullish. Like, you go back out 20 years to see how often it's even to the level that where it's at currently, and that's it. I mean, look at that. That's in the past. This is where we've gotten down to, and this level typically is an extreme to the upside, like we were in 2010 and 2011, and then a little bit in 2003 when we first started this bearish move. So needless to say, we had an extreme. I know it looks even more extreme on that chart, but when you look at it on this chart, I mean, it's even that much more. Like, this move was extreme. A 20% PPO, you can see, is double the previous peak practically for the PPO in the last 20 years. And if you were to go back even further, like say to 1980, when this big secular bullish trend started that ended in 2000, right, if you go all the way back to that 2080 time, well, I guess you can only go back to 97 on this current Russell. But again, there's only been a couple of other times there in 2000 when it finished, right, when the bull market finished. The Russell got up to 14.5%. So we kind of had big spike there, and then of course the divergence going into the 98 weakness started off with a peak above, just barely above current levels. So needless to say, even with it losing half of its bullish long-term momentum with this recent consolidation, that's still only I mean, we're still extremely high. There's still significant consolidation left for it to occur. Of course, take a look at the 3 green arrow charts, and for the S&P, and you can see we got a red arrow. All right, let me show you what that looks like in the 2-line version. The MACD has dropped below its moving average, so that's kind of like the next stage. Now, again, that's still, I mean, that we talked about that being, you know, the stage where you know, the MACD kind of moves in stages. The first stage being the divergence with positive momentum. The second stage being the divergence with waning momentum up until the time that your MACD peaks. That's your peak divergence. Then your convergence until you get the crossover. And then now we're still converging. As the MACD moves towards 0, you're converging. But as long as you're still positive, then you can see you can actually still rally. It's when it drops below 0. The MACD still is not anywhere close to crossing below 0. Of course, it is on IWM. It already is well below 0. So you can see that, you know, how the divergence, you know, this, for all we know, this could be the stage of divergence that the S&P is in right now before it finally has that kind of downturn that we're getting on the Russell 2000. Looking at some of the other oscillators, of course, for the RSI and the CCI, full-on bearish mode here for the RSI and the CCI. The directional movement index, full-on bearish mode there as well, well above 30, well below 20. The ADX is rising now up above 20. Should be getting a light green shading here as it crosses up above 20 here. Let's see, where's the trend strength indicator? There we go for the Russell 2000. We are now below -2. We're above 65, so we are in intermediate trend mode. We're below the cloud. The green line's below the blue line, which means the midpoint of the 9-day range is below the midpoint of the 26-day range. So all across the board, bearish indicators. If you look at where the, let's look at the Rune indicator for the S&P 5 or the IWM, you can see the negative is up above 70. The positive is working down below 20. That's, you know, obviously in bearish mode. If I were to give you some perspective, the last time we were in kind of an extended bearish mode, you can see that's, you know, the red line's above 70 and the green line's below 30. That's a bearish pattern until that changes. So that we just barely got that, because now your green line's below red. Now we don't have that on any of these indicators. You notice we don't have that yet. Like the green line is still, like, that's still a very bullish pattern, and we could bounce off of that. Like the Bollinger Band. So let's look at the Bollinger Bands for IWM. Let's look at that. Or the, excuse me, the DMI. The DMI, you know, we're still above 25 on the positive. We just barely crossed above 20 here. So we still haven't really ended the bullish trend yet that we're on. Now let's take a look at the Bollinger Bands. You can see we're still in the middle. We're not in the upper quintile anymore, but we've now crossed into the middle. IWM, that's not the case. We're actually in the lower quintile. We are pushing down. We have broken below the point of control, and you can see why breaking below that dotted line is so important, because there's just no volume below us. And if you go out 2 years, include the COVID drop, you can see again, no volume below that dotted line. A little bit of one there at that 38% retracement level. It's where the value area is going to be. So there's going to be a little bit of support in that area. But after that, there's nothing until you get down to this dotted line and this 50% retracement and the 161 level. So probably best case scenario here for the Russell, and worst case scenario down here for the Russell, for us to see how far down it could go. And in either way, it's just an exhale, right? It's just a deeper exhale than the other, which, considering how deep the inhale is and how long we've been holding our breath here, it kind of makes sense that you'll probably get a deeper exhale than normal, especially than what you would be comfortable with on that. Like I said, nowhere near bearishness yet on the S&P. And then, you know, looking at these other indicators, nowhere near bearishness here. We're still above 0 on the CCI. We're still above 50 on the RSI. So, I mean, we're not bullish anymore, but we're not bearish either on this indicator. If you take a look at the intraday chart, you can see the bearish move that we're getting, breaking below last week's low, kind of an outside day on the SPY, breaking below the point of control the last 4 weeks. But you see how bullish we're. I mean, we're still closer to forming a new high than we are a new low. Now, granted, you break below like that midpoint, and there's not very. I mean, we can fall pretty quickly, but we're not there yet. We are there, however, on IWM. I mean, we're finishing at the low of the week. We're finishing at the low of the last 4 weeks. That's pretty bearish and if I go out like a little bit longer on the time frame, say like out to 90 days. There's this. I mean, look at I mean, again, you can see why there's just no volume here if we break through these levels for IWM. So I still think that there's a good chance that support holds before we really get the weakness. And you can see how much weakness we can get on SPY and still run into some pretty decent support. And if you look at the same thing for the Qs, there's some weakness we can get there, but still run into some support. So really not break down per se. Let's take a look at today's volume and trading range. Let's go to this one. The volume hitting 75 million, the trading range there at 5 points. So both of those numbers are not too big, but that's actually, I mean, 5 points is right there, and the 75 million is right. I mean, those are both levels that are bearish because they're above these lines and make them lines go up, but they're not so extremely bearish that we can't get more like it. So that keep that in mind about the bearishness. I mean, that is a bearish day. Had it been more extreme, then probably something like we saw in these days, then you can see how quickly they can bounce because they just get so extreme. Eventually the averages, these lines move up because these numbers were so big. That's what happens if they are so big relative to their averages and so extreme. This is not the case, right? So, which means that we can get more of a steadier decline than a big drop that bounces up really sharply. Let's take a look at the volatility index. That's the big one. So volatility ended up finishing the expiration cycle off of that 80% level. So not nearly as bearish for volatility that we were expecting, that I was expecting. You can see the bounce off of that. I mean, literally in the last day, we were flirting earlier today with being below 80%, and we jumped up to the very end. Regardless, so even if we didn't necessarily finish at the most bearish, I mentioned to you before, we are entering a seasonally bullish time for volatility, and we might have just started a little early on that rally. I still think you can see that on average it's still July 21st where we get that low point, so that's still next week. So we might still pop down here a little bit just to get a lower shadow on the volatility index. So temporarily next week we might bounce off, but if we do bounce like Monday, Tuesday, Wednesday next week, it's only going to be temporary. Like eventually you can see what lies ahead typically, and you can see also what lies ahead because we're already seeing it in the Russell 2000, right? We're seeing it there. So and remember, when you're below the moving average, remember you get your biggest bullish moves. Like we just had a bullish move on the Russell last Friday, and that didn't really change. So we're still below the moving average. We can still get that kind of bullish move Monday, Tuesday, because we're still below the moving average. And the further below the moving average you get, the bigger the bullish moves, right? So that shows up here in this line, right? You get these bearish moves, they're followed up typically by bullish moves, and especially when you're below the moving average, we're getting, you typically get the biggest bullish moves the further below the moving average you are. So even today, look today, we ended up with a pretty significant bullish gap to the upside, and then filled that sucker in rapidly, and then some to the downside. So very, very bearish day for the small cap sector, which gapped up pretty significantly all the way up to there, and then fell immediately and fill in that gap, and like I said, got to a new low point. So I think there's a chance that we might kind of oversold technical bounce this up into this area, 222, maybe a little bit more up to 223, and then reverse. And so Monday, Tuesday, Wednesday, look for some some kind of oversold technical bounce, over bought volatility, and then sell that off. So for volatility to come back down a little bit here into maybe 16, 17 before we really get going, right? So remember, so that, you know, there's a chance we might get to 90%. We might start up higher on volatility, maybe gap down Monday. Who knows what it will actually look like? But you know, I wouldn't be surprised if we hit some resistance initially, because it's rare for us to go from 80 to 105. Nothing's ever 0 100%, but it's really rare for us to go from extreme low to, you know, pretty extreme high in one move, right? So usually you hit some resistance first, pull back, hit some support at this new support level, and then make a run from a higher low point than being at such an extreme. That's kind of what I expect. So we might, maybe a little bit of weakness Monday, maybe early, and then we rally early next week, and volatility drops before we hit that July 21st or plus or minus a few days or whatever. And then volatility will rally and trend higher and lead us into our next intermediate cycle, pullback cycle that, again, we are already experiencing on the Russell. So so if the Russell does bounce next week, remember, the biggest up days occur below the moving average, especially the further away you get from the moving average. So don't be surprised if we don't get a big up day Monday, Tuesday, Wednesday, or all three, and move our way back up there. But that doesn't necessarily mean that we're done, that the intermediate rally is done or pullback is done. It might just be a pause before everything starts to move lower, and not just the small cap index. All right, so before I'm going to break down kind of what's driving the price action. I'm going to break down the sector rotation moves like that and today's trade idea. But before I do that, what do you think about that technical outlook that we just had? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. I like to be able to see different points of view and what you might be looking at that makes you either a lot more bullish than I am broadly or a lot more bearish than I am. So share whatever charts or indicators that you're looking at that drives you to that view on the markets down in the comment section down below. All right, so now let's take a look at what's driving this price action. So let's go to this asset class comparison, and let's just look at just this week alone. So we'll go to July right there. We'll go like a 10-minute. So you can see small caps really were the significant outlier. Eventually, you know, the Qs were actually bullish for most of the week while small caps were declining. Eventually, the Qs dropped too and ended up being down for the week by 1%. The S&P 500 also down there following the Qs. The Russell down 5% on the week. That's significantly bearish, and that's not the first week, right? If you go back in the last 2 weeks, or the last 3 weeks, but if I go back the last 2 weeks especially, you know, we're down over 6% on the Russell. And look at the safety trade you have going on. The dollar's bullish, gold's bullish. Qs were bullish because they're considered a safety asset right now. The Qs were bullish. Gold, long-term bonds, real estate, all bullish. I mean, this is a risk-off trade. Commodities down, emerging markets down, not as much as small caps. Developed markets down, everything down. And now, finally, over the 2-week period, the Qs are finally following suit and moving lower too. So that chart that I've been showing you of this relative strength appears to have peaked, right? This appears to be the peak of its MACD. Again, remember the histogram peaks before the actual line does, and we looked like we've gotten the peak on the histogram. You see how there's a peak on the histogram, and then the line peak later. Here's a peak on the histogram, the line peak later. So usually, you know, the peak of the histogram has occurred and the line will peak later. And it looks like we're getting pretty close to that peak. That doesn't necessarily mean that we have to drop. It just means that the divergence is over with the positive momentum is over. Now we'll get, or at least the divergence, excuse me, with the increasing and the waning momentum. Now we get the convergence, right, which starts off with just the lines not moving away from each other anymore, right? And it doesn't necessarily mean that they have to come together like this, but at first it just starts off with they don't move away from each other anymore. They just stop. You can see how the line rolls over before crossing below the red line. It just stops going up very much. That's what I think we head into next week. So we can still be bullish, but we just stop diverging. And this has been such an extreme level for the PPO here relative to what we've seen in the past. If you go back 20 years on this PPO, the second indicator. I mean, look how, I mean, that was an extreme level for this PPO relative to what we've seen. We saw, that over here, and that ended up being a peak in 2011 with the credit crisis. It's a very, very high level. We saw that again over here in June or July and September when we had our intermediate peaks. So we're having it again, right? Very, very extreme. I expect that now will slow down, especially with this RSI, with this divergence on the CCI, with the RSI at extreme levels. You would expect that it would roll back down now away from extreme levels on this rotation chart. And if you look at this chart and you say, okay, here let's go to growth, value, and size. This is the weekly chart, and you can see small caps and value stocks are moving down to the left, and you can see the big gainers are your large cap and large cap growth. That's why I say they're safe haven. These are safe havens right now, where the risk asset classes are your small cap and your values, and they're moving down, and there's small cap growth and small cap moving down to the left. So that rotation on the long term is starting. We're starting to see that now more in the short term on the daily chart, where you see, in red you have your small cap, your mid cap values, which have been going down to the left, and then there's some values starting to pick up here, large cap values, with your growth areas holding their values, large cap and large cap growth holding their gains, and you expect that that will be the case as we get this big risk off move away from those the anti-work at home, right? The anti-stay at home trade. That was the value trade, the stocks that were beaten up during COVID, that bounced up so sharply into this spring, from last fall to this spring. Now that they are now money's coming out of there and moving into other areas, and you can see that as well in the sector ETFs. The ETFs where all that was taking place were financials and industrials and materials and energy, and now they're going back into some of these other areas on the weekly, and then you can see especially on the daily chart they're just going in the opposite direction here. Look at energy really diving, and you can see even some of these cyclical areas, and look at utilities and staples and real estate all moving up to the right at very fast speeds. The market is moving into safety as we speak. You can also see that too here. If I were to go to this chart from the global 12 grid, you can see that in some of these areas as well. Look at, we got light green shading and the red line, but we're still well below the moving average, back below the moving average there for Japan. Look at all of these dropping. Italy getting a cluster. Dark pink shading and red lines across the board. Light green shading and red lines for those that aren't so bearish. And then you've got, for all of these, Korea, India, China, and Brazil, all light green shading and red lines. So, and they're all, you notice, in the lower half of the chart. And then you have the light pink shading and the red line, and you can see how close we are to getting dark pink shading as that flips from 52 to 50. If I look at the different asset classes themselves, you can see some of their charts here. Look at the developed markets dropping. Look at EEM. See, it's got that light green shading, but the red line. You can see real estate kind of settling down. Look at the 10-year yield dropping like a rock. The dollar's rallying. Gold is reversing with that strength in the dollar. Crude oil doing it, starting to pull back a little bit more. And foreign bonds taking off, and long-term bonds making a run. So let's take a look at some of those charts here on a bigger, more visible scale. Here is the 10-year yield, the drop that it's having. It's getting down. I think it's going to find some support at worst in this little area right here. 1.15% is about as far down as it can go, which means CLT probably has some resistance up here, maybe at that 78% level in the worst case scenario. So as we do transition more to a risk off move, watch for that level. For the dollar, we're kind of at its low point, or low point for the euro, high point for the dollar. You might go down to this 117, but that's probably where most of its strength will get it to. If it does go further than that, let me zoom out so you can see. If it does go further than that, then you're looking at probably down to that trend line, which by then would be sitting on that 62% retracement, the big Fibonacci support level of this rally that we've had. So so that would mean we're breaking the 38%. I think that's our worst case scenario for the euro, this bullishness for the dollar. Otherwise, I think we just kind of stay in this area for a while, kind of like this, where we kind of roll over and then just hammer around there until we turn back around and risk appetite increases again. You saw in that sector rotation a move to risk off. Well, here's what it looks like here this past week. And it was really a 2-week chart, but if we take a look at the past week, the past week right there, and we'll look at like a 15-minute, then you can see, again, utility, staples, real estate, right? And technology had been holding up. Again, that's been a safety trade, but now it's falling, where energy and financials and discretionary and materials and industrials are all falling there. And that's just the last week. Like I said, if you go last 2 weeks, then you can see, again, the weakness, almost over 10% drop in energy stocks there. Look at this chart though. See, this is what I've been showing you too. This sector comparison, not this one, the 12 grid. There's been such a discrepancy between the ones up here and the ones down here, and look at that. I mean, look at the dark pink shading and the red line, and just bearish charts across here. And look how bullish these are, but you see how they're, some bearish candles that we haven't seen for a while, and utilities and staples and real estate are all rallying pretty sharply. And healthcare kind of stuck in the middle, really not really dropping, but not really rallying, kind of flattening, because it's got some of both, right? It can be a tech cyclical area. It's got some tech cyclical areas within it, but it also has the safety areas within it too. So it kind of can match both of these spots. All right, now let's take a look at our trade idea of the day, and I want to take a look at MasterCard. MasterCard's on a nice little new bullish intermediate run, a little bit of an engulfing pattern here that might cause a little short-term weakness, but the reality is the intermediate line just barely crossed above 80. This drop here has produced an intermediate confirmation signal, overbought or a bullish intermediate posture, strong bullish intermediate posture with an oversold momentum line that didn't get to an extreme. The near-term line is down, but just a smidgen. It's not down. It's not even out of the bullish territory yet, below 60. If you take a look at some of its other charts, you can see why we dropped today, because we were so far. We had made such a strong bullish move to get above the 8-day moving average that we didn't even really get down to it. And the question is whether or not the MACD is done peaking here. You can see the histogram looks like it might be rolling over, but remember, usually the peak can come later. If you take a look at the 2-line versions of the long-term charts of the 1040 crossover, you can see we had been bearish. We got the transition candles and have turned back to bullish. You can see from a DMI standpoint, we have a bullish breakout pattern here, getting above 30, even though we pulled back a little. We're still above 25, but we did break out above 30. We broke down below 20. So a nice good breakout pattern there. You can see the RSI is broken and CCI is broken up to bullish levels. That's a very good sign too. You look from the Bollinger Bands, you can see that we're above the point of control, or excuse me, the value area. We have broken out above that. Even with the drop today, we're still in the upper quartile of the Bollinger Band width. That is still rising. You can see the band width is still rising, so we're still expanding there. From a trend strength perspective, we have a good trend. We're above 2, we're above 65, so we got a good intermediate trend going, breaking up above the cloud there. Take a look at I wanted to look at the Arun indicators, what I want to look at. So that 4-week chart, you can see we got a good bullish sign level here on the breakout. We got, even with today's drop, we still got a new high. The high of the day is still here on the day, and then the low of the day is on 20 days ago, the 20th day. So we still have a very good intraday pattern here on the chart. Let me look at it from this perspective. And we opened at the high of the day today, and the low is over here, and the low will still be over there for a while, and the high, depending upon where we go, we might pop, the green line might pop down a day or two as we might fill in some of this in, but you can see where there's some obvious support and the opportunity for a bounce. even if there's some short-term weakness in the next day or two. So what kind of trade can I do where I'm going to do a bullish trade, but I want that flexibility in case there's any short-term weakness in the short term? Well, that's where bull put spreads come in. It's bullish, but it gives the stock ability to come down to 375, so it's about $11 before it starts flirting with being in the money at all. And remember that there's a 33 delta, so there's actually a high probability that the stock will touch 375. Doesn't mean it will stay there, but there's a high probability that we'll touch it down in this level. So kind of gives you an idea of the likelihood, just how far out of the money that it is. So we sell the 375, buy the 370 put, position size for full position, going for 30% return on risk. That break-even level, you can see where that break-even level is. If I put it over here on this chart, you can see that's what that break-even level is. So we'd have to essentially break down below support of this 4-week range, the point of control over the last 4 weeks. If I go back out a little further, kind of give you a 90-day look at this, then you can see that's where that there's where that level of volume is. So you can, there's some pretty decent support in this area that can keep it up above where my break-even is. All right, and that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. All of our subscribers, even our free subscribers, have access to that forum. Post any new threads, reply to anybody else's threads with any questions or comments you have about what we talked about. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your weekend, everybody, and we'll see you all next week.